Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 242 and today is 7th of June 2022. We're going to talk about patience and time, which are underrated in the market. And returns are obviously, the most sought after thing in the market, but they are overrated in our view. So even with reasonable returns, if you have patience and time is on your side, you will still do quite well. But we don't usually pay much importance to the time and the patience in the markets. First, to look at the markets. So a reasonably sort of a dull and down day today, coming on the back of weaker cues again from overseas. Domestically, FIs have been selling. There is more fear about rates going up in the upcoming RBI meet later this week. There is fear about US interest rate hike also this month, and the European Central Bank is also to meet this week and stop their easing policy. So all in all, a sort of a hawkish sentiment all around, and that's why the stocks are a bit soft, and there is general sort of sentiment of market wanting to settle and find some base which has not been able to so far. So usually, as we have seen in several other daily bites, we have 6 to 18 month kind of market falls usually when we go into a bear market. We are not sure how long this can last, but at least that much time we must give to the market to consolidate, given that we have had a huge run post the COVID crash in the last two years and 1 quarter, I would say. So given that background, I would still say that the Indian market has done fantastically well over the last 1 year also. We are not even down 15% on the index, and the global markets, if you look at other Asian markets like Hong Kong or the US market or some particular European markets, I mean, there has been a lot of damage everywhere, but we have been saved thanks also to the retail participation and domestic money that has flown into the markets. So today's market, essentially most sectors were down. Real estate leading the pack down minus 1.6%. IT stocks down after Nasdaq stocks were beaten down and futures were down today. FMCG, the reports are pointing towards inflation pressure and not able to pass on the price hikes. Consumption stocks like Titan and other stocks were down quite badly. Pharma stocks also beaten badly. The only sort of region where we saw some green was energy stocks, some auto stocks, and public sector enterprise. So this was the only sort of pocket which had some green on it. Otherwise, it has been quite a dull and down day. In terms of the broader indices, small caps and mid caps actually did not fall as much as the Nifty. So there seems to be some relative strength there versus the large caps. But Nifty Next 50, CNX 500, CNX 200, they were all down 0.8 to 0.9%. In terms of weekend investing strategies, again, many strategies were slightly in the green. That was quite surprising as well. But some strategies had some mild down day. So not really very aggressively in either direction. So I would consider it to be a sort of a sideways move that we had. So a new kind of a heat map that we are sharing today. So this is the Nifty heat map. Each block is based on the market cap of that company. So Reliance has the highest market cap, so this is the biggest block, and there could be some very small blocks here which have the lowest market cap within Nifty, IndusInd Bank maybe, or maybe somebody else. So, and this is also grouped as per the the sectors. So what we can see immediately is that the energy, mineral sector here, Reliance, ONGC, Coal India, they were all green. And the larger damage was in IT here and FMCG here. So levers down 3%, Britannia down 3%, Nestle down 1.5%. Autos doing all right, plus 1.2% here. Tata Motors also plus here. Titan in the consumption space going minus 4.5%. Asian Paints again they've classified as process industries minus 2.5% here. Pharma also taking a dive here. Dr. Reddy's, I think this one minus nearly 3%. Sun Pharma down minus 1.4%. Mild losses on the cement stocks here. IT stocks all down 1 to 2%. And within the banking and finance space, pretty much everything was in the red. State Bank was pretty much flat today. So the heat map does give a very quick picture of the entire day, where ONGC obviously was the highest gainer at plus 5% on the back of very strong oil prices, and more than that, the market forecast by Goldman and several other agencies predicting $140 oil within the next quarter. So that while is good for several companies, I mean there were other refining companies like MRPL and Cochin Refinery, etc., which were flying, but a $140 oil is not good for our overall market for sure. So that is what is causing the gloom a little bit. But what we've seen is that sometimes all these predictions really don't fructify. MRPL, as I said, up 19%, EPL up 5%, ONGC up 5%, Scient up 5%, and Brightcom Group also up 5% in the top gainers. PB FinTech was down 12%. So this is now again near its all-time lows and closing very fast to its all-time lows. There was some big transaction that happened, and I'm not sure, but I read on Twitter that promoters are selling some stake. So if promoters are selling a stake after stock has fallen 60-70% and at all-time lows, I mean, God knows where this is going then. But I could be totally wrong on this, so don't hold me for this. Zomato down again, minus 6%. So there are these small bursts of bear runs in several of these weak stocks, and they will jump up extremely hard and putting you on the wrong foot in terms of thinking that these stocks have bottomed out and it's now going up. Please wait for all these falling knives to come to some bottom, consolidate, create a pattern of upward movement, at least one higher high if you can see breaking some important pivot. That should be, at least the patience should be there to wait for that. I mean, why you want to try and pick the bottom. TCNS Clothing also minus 5%, Gujarat Gas and Titan, as I said, also down nearly 5%. Another insight from our favorite Charlie Bilelio. He provides fantastic data, so please follow him on Twitter. I regularly follow him and quote him also on our daily Bytes. Just see the global inflation rates and just see the countries which are experiencing this. I mean, who would have thought that Germany will have 8% inflation, Portugal, New Zealand, Canada, even Finland and Singapore. I mean, Singapore, just for reference, my one very dear friend, he has purchased a house there, and he was telling me just yesterday that he's paying a mortgage of 1.3%. Now, at 5.4%, if you can get a mortgage of 1.3%, I mean, you are actually the bank is giving you money, right? I mean, in real terms, you've got a mortgage of negative real rates. So similarly in India, actually also, so at 7.8%, if you're getting a real estate loan at 7%, you're actually getting it free for all practical purposes. So from that perspective, you know, taking out loans is not such a bad deal, I would say, given that your house or your invested property will hopefully beat inflation. But it is amazing that US is at 8.3, Netherlands is at 9.6, Eurozone, the entire Eurozone is at 9.1, UK is 9, and of course you can't even talk about Turkey, Venezuela, Argentina, and so on and so forth. So this is a huge sort of a macro event playing out. Somehow we are not paying too much importance to it, or we are, at least the media is not bringing it out as if it's a once in a half a century type of an event. I mean, the last time these kind of inflation rates were there, we were in the 70s. So it's been 50 years since we've seen these kind of inflation rates, and who knows what kind of implications that this may have. Everybody is kind of very cool about it right now, that we'll be able to manage this somehow. But that's why I can continuously stress that do not depend on one asset class. Do an asset allocation. Real estate and gold have done very well in high inflationary environment in the past century. There is no reason why the same will not happen. So don't just assume that what we have seen over the last 10 years, 15 years will continue to happen over the next 10, 15 years. That may not be the right assumption to make. Another insight was on LIC. So LIC, ever since it has got listed, it is going down, and it is from 920 levels achieved in the first hour after listing, it is down to 752 or something like that at close today. So again, I mean, on the third day of the listing, it broke its all-time low of its existence. So in the third day itself, it broke its low in the market, and that itself gave at least me a very sort of a negative signal that if a stock cannot hold even its 2 or 3 day low, then it has more room to go, likely. So it is just going down, and at some point it will flare up and create some pivot. So wait for that pivot. I mean, right now, I mean, there is no reason to buy it unless you are like, let me either do some dollar cost averaging or I just buy it and 752 and sit on it for 10 years. Maybe, I mean, that may be a very good trade. I don't know, but why would I want to do that if I'm looking for a good entry point? So allow the stock to tell you when it wants you to buy it. That is the basic bottom line that I'm trying to get at, is that instead of you guessing when to buy, why don't you allow the stock to tell you when to buy? So that 4 principles that you always must have: what to buy, when to buy, how much to buy, and when to sell. I mean, these rules you have to make for yourself, whether you're doing momentum investing or whether you're doing any other investing. These rules have to be made, and a rule cannot be that if a stock is falling, I am buying because it is falling. That is not a good enough reason, I think. So even if LIC is a huge name, fantastic pedigree, and I'm sure at some point it will turn around and do very well, but why you want to put yourself into that position of grief for the next even one day if it goes to 700 and comes back? Allow the market to tell you a story when it does. So essentially, again, patience and time are important, as we have seen in all the previous cases. I tweeted today that there's a common expectation that if a flower may bloom in 3 to 5 weeks, if it doesn't in 1 week, I mean, do we get upset about it? I mean, we already know that our expectation is 3 to 5 weeks, right? So similarly in stocks, I mean, we are lucky if we get some returns in 6 months, 1 year, 2 years, mostly. But usually it will take 3 to 5 years once the cycle has taken its entire shape and you've invested gradually over it. Only then the real returns actually start to come. What we've seen in the last 2 years was extremely lucky situation for many of us who were able to get in at the right time. But that should not be taken it as a norm that whenever you will come to the market within 6 months you will make 20%. I mean, that should not be a norm in your mind. You should have the realistic expectation, and yes, if that realistic expectation is bettered by your luck, I mean, that is fantastic then in that case. So that's all I had for this short daily bite. Thank you so much for watching. Please do give us some likes. The channel subscription is not really blooming the way it should, given that we are putting in a lot of insights, a lot of hard work into this. So please do share it with your friends and make it successful. Thank you. Bye.